So you're a business owner looking to create financial freedom faster. I'm going to run you through our investment operating system framework that we use to help our clients deeply understand the decision-making process that goes into building wealth. The big issue for the vast majority of people is that they're flying blind, they're guesstimating, they're throwing darts at a dartboard. And what this fundamentally comes down to is that they don't have a objective decision-making process around what they're actually trying to achieve, what are the best financial vehicles to get them there, and then how do they optimize and improve their trajectory so they can hopefully get to financial freedom faster. In turn, they do things emotionally, they do things subjectively, they do not do things systematically, and for that reason, they fall short of their goals and objectives, and they make silly mistakes that could be avoidable. We refer to this as basically having wealth systems. We want to make sure that we have a proven process, that we have a decision-making framework that ensures that we are considering all of the available options, and we're improving and optimizing over time because we're focusing on progress over perfection. I'm going to share with you our philosophy first that I've covered off in a number of my books, namely Seven-Figure Profits, and then I'm going to share with you how to actually put this into a financial projection tool called ProjectionLab. And this is one of the reasons why we want to talk about the philosophy first before we get into kind of tools and gadgets, because unless you understand the philosophy, you're not going to be able to extract value from it. So let's get stuck in. So what I want to share with you guys is our decision-making framework that I covered off in Seven-Figure Profits. And what this essentially is it's a decision-making logic that goes through a series of 9 questions that our clients typically will evaluate at least on a quarterly basis to ensure that they are moving their financial needle forwards. Now, the idea here is that this allows us to identify what are the lowest hanging fruit, where are the biggest opportunities, and then essentially continually optimize these stages over time. So question number 1 is always, what can I do to grow my income? One of the traditional principles of wealth building that I feel is fundamentally flawed is that the vast majority of people, when it comes to wealth, assume that income is fixed, and therefore they only focus on cutting expenses. For this reason, it means that they leave a tremendous amount of opportunity on the table. And as a business owner, I know that I have a lot more control over my ability to increase my income than I do over cutting my expenses. So I want to focus on, well, where can I increase my income? Can I increase my salary? Can I increase my profit? Or are there actually strategies of arbitrage? Meaning that if I implement a tax structure or I implement a financial tactic, is there a way that I can keep more cents out of every dollar as a result? This produces my active income, essentially the income that comes by way of my personal exertion and my intellectual property. Next, how do I control my expenses? Be very mindful that I use the word control, not cut, because I don't believe in cutting your expenses. I believe that your expenses are like a muscle. Like your body, we want to trim fat, but we don't want to cut into the muscle because we then compromise the body's ability or your ability to be able to sustain it and do any meaningful work. Okay, so I want us to control the expenses so we don't encounter the cash flow creep that most people experience when their income goes up and their expenses increase proportionately, in some cases above and beyond their income growth, which means they have no more surplus to show for it. And it is these 2 factors that then influence our surplus, because wealth is built with surplus, okay? Next, we want to consider our goals. And our goals go into a series of stages. So the first stage is the war chest. What do I need to have available in a war chest to give me peace of mind and certainty in the event of the unforeseen? Car engine blowing up, emergency trip overseas to care for a family member, something urgent that's come up unforeseen. For most people, this number varies. Obviously, there's the philosophy that's been thrown around of 3 months of living expenses. I prefer to turn this into a dollar figure, so we decide on it. And for the vast majority of our clients, it's a number between like 20,000 and 100,000, depending on their situation. Next, what are my lifestyle goals, okay? What are the things that I'm trying to work towards from a lifestyle perspective that are going to give me certainty around being able to achieve the quality of life that I want? So lifestyle goals typically that we see is obviously, what's the home that you want to buy? When do you want to have that paid off? Do you want to do renovations? Do you want to send the kids to private school? How often do you want to turn over cars? What kind of holidays do you want? How frequently? What's that going to cost you per annum? Are there hobbies, interests that you want? Are there toys that you want? Boats, jet skis, all of these kinds of things. Lifestyle goals are about enhancing the quality of your life and are usually going to come down to time and or money. And we want to try and quantify those goals to both of those as much as possible. Now, the clearer we are on the lifestyle goals, the easier it is for us to define financial goals. Because ultimately we're trying to balance lifestyle now and financial options later. And usually it's about having an enhanced lifestyle later or more flexibility around that lifestyle later. So when we can define the lifestyle goals both now and into the future, we can make it really easy for us to determine the financial resources required. So now, do you want to build a property portfolio? How much passive income do you need in order to be financially free? What age do you want to achieve that? Do you want to help your kids get onto the property ladder? Do you want to set them up with a nest egg to maybe start their first business or fund their university? We can quantify all of those financial goals. And as a result of that quantification, we can then get to number 6, which is the allocation strategy. How do I allocate my surplus to be able to achieve my goals and manage my risk? And we've got to realize there's basically 3 buckets for wealth creation. There is low risk, which is cash, and that's typically your war chest. We want to have liquidity in order to prepare against the unforeseen and have money aside for certain opportunities that might present themselves. Second, medium risk, income assets. This is blue chip property and blue chip stocks that pay high dividends. We want things that produce income because we can't eat the capital, right? And then the high risk is growth assets. These are typically the ones that are going to be most volatile, but that's what's going to give us the ability to compound our portfolio because income doesn't compound. We want to be able to reinvest that capital and ideally have unrealized capital gains because this is where a lot of tax efficiency will come from, okay? Then we get into return expectations. So my philosophy on this is that we allocate wealth based on the expected return required in order for you to achieve your goals. So for me, I use an assumed rate of return of 8%. I invest as a growth investor. I know that historically a diversified index fund or a good quality property returns about 8% a year. So therefore, that's my return expectation. And I don't try and overpromise and overdeliver on that. I want to set a realistic and reasonable expectation because the other levers are easier to pull, okay? Then the next one is, am I going to use leverage in order to accelerate my path to wealth or magnify my results? So for example, bad debt. This is accelerating goals. You could work and save up to try and buy your home in full, right? But if we think that property goes up by 8 to 10% a year, how long is it going to take you to be able to save up to buy that property? How much opportunity you're missing as a result of not using bad debt to accelerate that goal? Or potentially, you're like, well, I want to drive a nice car, but I don't want to own it. I'd prefer to take that lump sum of money and put that into investment. So I'm going to lease my car and I'm going to rent it, right? And pay a monthly repayment because I want to accelerate that goal, okay? And then we've got good debt, which is used for investment purposes, and that magnifies returns because debt is a magnifier of good situations and also bad situations, okay? If you buy an investment property, let's say for $1 million, and that investment property goes up by 5%, and you put in a 10% deposit, so $100,000, it's a 5% return on the asset, but it's a 50% return on your cash because the property's gone up by 50 grand, you only put in 100,000. So that's magnified your return tenfold, okay? And that is what we need to evaluate. Okay, are we prepared to do that? But most importantly, can we afford to hold that leverage? Because for many people, they over leverage themselves and they can't control and afford the cash flows, and that forces them to fire sell. And we don't want to be in that position. And then lastly, we've got the ninth component, which is, does my net wealth have me on track? Is my passive wealth on track to achieve my goals? Am I on track in terms of my leverage? Because obviously at some point in the future, you don't want to have any leverage. So am I on track for my plan? And then we can optimize and go back to number 1. So this is the philosophy, guys. This is the whole philosophy around how you go about making these decisions. But then once you understand the philosophy, the next biggest issue is then how do we crunch the numbers? So what I'm going to share with you is basically a tool that you can use. And look, I preface by saying that this is a retail tool for individuals to use themselves. It does have a decent level of sophistication. However, when you're working with a financial advisor, we typically have access to wholesale and institutional level tools that have a much higher level of sophistication. They've got more details in terms of running scenarios. The numbers are typically more accurate. They allow us to look at things like family trusts, bucket companies, self-managed superannuation, debt recycling strategies, all of these advanced strategies that as a layperson, you can't be expected to know. So therefore, these types of tools exclude them from the feature suite, but it can give you a pretty rough idea and it's better than doing nothing, okay? So what we basically want to consider here, guys, is that one of the fundamental pillars of being able to create financial freedom for our clients is defining what they want and basically creating a roadmap to get there. So many people sweat on this idea of, well, what path should I take? They're overwhelmed by choice. They're overwhelmed by the sheer amount of information that's available. And they aren't really sure the opportunity cost of certain decisions. What are the risk versus return trade-offs? What if I do this? What if I do that? They get overwhelmed by the sheer complexity of all of the scenarios that they're trying to run, that they end up basically doing nothing, or they just guesstimate and kind of said, she'll be right, and they see what happens. So a tool called ProjectionLab will allow you to start working through building a roadmap. I'm going to give you a crash course with my own numbers. This is exactly my numbers, and I'm going to show you exactly how I go through the scenarios for myself and how I continue to optimize. Now, this is not advice. I just want to give you some examples, and I want you to go away and experiment with this. And if you do find yourself hitting a brick wall, you're not quite sure what ifs to do, you're still not quite sure how to make these decisions, you need to seek professional advice. I urge you to do that anyway, because even though you might be using a tool like this with your advisor, the idea is that as a result of knowing this stuff and working with a professional, then they can help you elevate your position and hold you accountable to taking action. Because at the end of the day, a good idea in theory is exactly that, just a good idea until you put it into practice. Okay? So let's go through this. So as it stands right now, my personal net wealth is $5.94 million. Okay? And that's comprised of about $7.92 million of assets and about $1.98 million in liabilities, okay? And that's a mixture of business and private investment holdings, home, superannuation, and other investments that I hold outside of my business. Now, I am unlike a lot of people whereby I actually build wealth via my business. The reason for this is that I've created a diversified group of various businesses that I've invested in and accumulated stakes in. And I also have entities in my group that allow me to invest in property and shares. And I do this because it gives me an opportunity to use tax arbitrage, one of those active income levers, in order to avoid having to pay top marginal tax rate to only then reinvest the amount of money. And therefore, by keeping it in the business group, I typically only pay about 25% in tax, which in many cases provides me with an additional 19% that I could invest, as opposed to alternative strategies. Some other people will prefer not to do that, so therefore they may have more exposure in their own name, okay? Now, what we basically do is we go through and set up the current finances. So we put in details like what's the home, what did you pay for it, what's the current loan balance, what's the percentages, business assets, savings, investments, real assets, unsecured debts, and obviously breakdown of your personal situation, okay? And then typically what we want to do is we want to create a plan. Now, for the purpose of this exercise, I'm going to start a plan from scratch. And I'm actually going to walk you through it step by step of how I do that. So we're going to do a new plan, and we're going to do this from now, and we're going to start this from today, okay? And we're going to call this current plan demo, just for the purposes of this exercise, okay? Now, this might take you a couple of hours to put together, guys, if you really want to do it comprehensively. Obviously, I'm trying to make this video as short and sharp as possible, so I'm going to be flying through this. If you do have questions, chuck it in the comments, and I'll make sure I can do some updated videos. So, the first thing that we need to consider is that we need to determine the difference between retirement and financial independence, okay? So, retirement is the basis that you stop working. All of your active income ceases, okay? And financial independence is when you have the financial means and resources to choose what you do with your time. And those two things are mutually exclusive from each other. The third element is the end of the plan. And I'm going to give you some assumptions. So my typical go-to is that retirement should be age 60. Even though I never plan to retire, I want to focus on the worst case scenario in this particular scenario. But maybe my health doesn't allow me to, or something else comes up. Next thing. I want to focus on the plan going to age 100. Many of these kind of short-sighted scenarios are based on life expectancy. And once again, we want to work off the worst case scenario. The worst case scenario is that you stop working the soonest and you live the longest. So we want that to go to at least 100, because what do you want to do? What happens if you live longer and you don't have enough wealth? I'd much prefer to have money left over than to not have enough. And then we want to look at financial independence. So usually financial independence is on the basis of your total living expenses being 25 times your net wealth, okay? And then what I also want to do is I typically want to add in another milestone, which is called Fat Fire. And there's plenty of other ones that you can have here. But Fat Fire is on the basis of having 50 times. So the idea here is, guys, like at 25 times, you are likely going to draw down all of the income associated with your portfolio, assuming that it's invested relatively conservatively. And at 50 times, it means that you're probably not even going to be able to spend the income that's being produced, which should mean that your wealth will increase in perpetuity. There's a lot of other milestones that you could put in. So custom milestones, for example, if there's a certain lifestyle goal, being debt-free by a particular age, school, gap years, getting married, kids, all of these kinds of things. I'm also going to put in being debt-free. And the idea here is that we want to be completely debt-free, equaling 0, and working out at the earliest age that we could achieve that particular goal, okay? And we could also change this if we wish to put this into a currency. We could put this into certain variables or based on certain balances of debt. So I'm just going to keep that as $0 in actual currency, okay? We're going to go continue. Then the assumptions. This is a basic assumption on fixed rates, so it's even more conservative than my assumptions. 6% growth rate, dividend yield of 2.5%, inflation at 3% means our real return is 5.34%. You can also go off historicals through various years. You could do advanced. For the purposes of this, I'm just going to do fixed rate to keep it simple. Sources of income, okay? Now, we're going to work out, and usually what I do is I put in salary. So for the purpose of this, in my business, I pay myself a salary of $100,000. It's annual, it goes until retirement, and let's just say that it matches inflation. We usually put withholding taxes at 25%. It will do an excess tax tables calculation, so this really doesn't matter. But for the purposes of this, I'm just going to add that in. I'm then going to add in Anna's salary at, I think it's 95,000. And we match that with inflation, and we continue that here. And then what we also do is we put in custom income, which is going to be business profit, and we typically distribute 500,000 a year from the business, and we treat this as dividend income. Cool. And this is going to be yearly, and we're going to do that until retirement. And we're going to do yearly changes, match inflation, okay? And add that in. Cool. We're then going to continue. And we're going to go cash flow priorities. So typically cash flow priorities is going to be, well, first thing, war chest. Okay, war chest for us, we've got a big war chest in the business, and everything else we keep an offset. But for the purpose of this exercise, just so I can show you, we're going to set that at 100,000, okay? And this basically allows you to work out how that's drawn down, and we click that, add that in. Next, we're going to say we want to focus on taxable investments because from my perspective, I want to focus on building as much liquid wealth prior to preservation age and superannuation as humanly possible. And what I'm personally going to do is I'm going to use 50% of my surplus that's left over, and I'm going to dedicate that to investing. Next thing I'm going to do is we're going to focus on the house repayments. And same thing, we want to focus on remaining income, and we want to put 50% of that. And the idea behind this is that obviously investing, typically speaking, assuming that you're investing in growth assets, is usually going to result in a better return than what the typical interest rate is going to be on your mortgage. However, paying off your mortgage is a guaranteed risk-free rate of return. And for that reason, we want to kind of split that. That also gives me opportunity to redraw and use that for other investments in the future, okay? And if you want to have other cash flow priorities, you can put them in, and anything else we can put into superannuation. For the purpose of this, I'm not going to put that in. I'm just going to keep it simple. Okay, let's add in expenses. So our living expenses, not including our mortgage. Let me just show you guys, and I'll pull this up. I keep a tracking spreadsheet that has all of this. So our monthly expenses are, let me just pull up our reporting or your story. So we've got 37,000 a month, but that also includes debt repayments, which are already been factored in, and tax savings. So we've got 4,000, that and that. So 26,000, and we minus that from the 37,000. So it's about 11,000 a month. So that is going to be about $130,000 a year. Let's just chuck that in, 130, okay. And then we do that to match inflation. And we continue. We've got current real assets if we want to add in other assets of acquiring property and whatnot. But for the purpose of this, we want to have a baseline, and we want to continue. And then we add the international preset, which is Australia, which ensures that we apply the Australian tax tables. If you're in a different country, you can apply that to this as well. Cool. So what this will basically do is this will create a financial model of your current position, okay? And this is important because we want to create a baseline. And that baseline is basically going to be one of three potential outcomes. One, you're actually in a good position to achieve your goals. Beautiful. That's very rare. Two, you fall short of your goals and objectives. So there's some optimizations and other scenarios that we need to look at doing to help you bridge that gap. Or three, you go bankrupt. Your current position is not sustainable, and therefore you're going to erode your wealth much faster than you intend, and you'll fall short of all of your goals, basically end up in zero or negative net wealth. And the system will actually notify you of that if that happens. Let me just show you. If I reduce this, because obviously we've got a significant amount of repayments, as you can see here, it'll say, "Hey, bankrupt," and this will be factored in. I'm going to put this back to here. Okay, and I'm also going to chuck in custom expense, business loan, and that's 200,000 a year, yearly, and that is for 10 years until I am 45. Cool. Add. All right, so here we go. So my current position basically on this is, okay, at the moment, we've got about $5.943 million in net wealth, factoring all of these things in, okay? And essentially, we get to the $100,000 in savings by the 16th of September, 2025. Beautiful, cool. So that's $6.242 million. Then business loan, I've got that in here as an expense. If you've got personal business loans that are not within the business, I bought out some shareholders. I took that loan personally. So I'm focusing on paying that off. I'm not making any additional repayments because to me it's tax deductible debt and there's better things for me to do with my money. But that's fully paid off by here. And as you can see, because it's consuming such a significant amount of surplus, we have the home paid off by 49 and we have financial independence by 52. And then we basically have final year of salary and business profit. Retirement is age 60. Anna's retirement when I'm 62. And then we hit Fat Fire by 63. Now, I also haven't factored in any sale of my business or basically disposal of that. So I could jump in here and I could do that in this particular scenario to come into Aureus and basically say, I am going to sell the business at retirement and click save. And as we can see, this will be factored in here. Just going to make sure that we've got the right compounding. We're going to have appreciate by 10% a year. And this will then say that I sell the business for 34 million, let's say. Okay. Once again, this is just a scenario. Our philosophy around doing this kind of number crunching is ideally you want to be financially free without selling your business and then do a scenario to see what happens if you sell your business on top of that particular outcome, okay? So what we then do is we've got this particular scenario and we can see where we're at. Now, what this can allow us to do is we want to have a look through things like cash flow. Well, where's the money actually going, okay? So we've got earned income coming in, business profit coming in. Here's our tax withholding. Here's our expenses, debt reductions, all of those other things, all of the outflows. And the great thing about this system is we can look at this, what happens year on year. How does that continue to shift and change over time? And that basically just helps you identify the various stages of your plan. We also then see what is your tax over time. So we can say, okay, well, what's your effective tax bracket? How much are you paying? Essentially, where do you end up? What does that look like over time? And essentially, what's your net wealth going to be from a legacy standpoint based at your end of life? So this is really important because for most of us as independently wealthy business owners who are first generation, we're going to need to consider that transfer of wealth at some point in the future. So that's going to be critically important for you to consider and start preparing for that. Good news is I wrote a book on it called The Family Vault that runs you through how to do that. And I guess the other part around this is this also allows us to consider, well, okay, my effective tax rate or my average tax rate throughout the course of my life is 39%. Well, but as a result, I've been able to build all of this phenomenal wealth. I'd be happy to spend 39% in order to end up with $120 million but at the end of life, right? This is about understanding what is the trade-off between the cost of doing business, the ability for you to achieve your goals and objectives. And this is a really cool part of the system that we call chance of success. And it's basically a Monte Carlo testing scenario. And what it basically does is it does 192 different scenarios through different time periods to consider the likelihood of you being able to achieve your goals. And as you can see here, I have a 96.88% probability based on these 92 scenarios, whereby 85% of the time I end up with a large surplus, so like 300% more than what I need. Comfortable, basically I never ran out of money and I leave a sizable legacy about 10% of the time. And then 3.1%, we depleted the portfolio less than 40% of the way through the plan. And as we can see here, it basically says, well, at the end of the plan, in the bottom 10%, I end up with 113 million. There's various scenarios in terms of total expenses, of net wealth positions, in terms of the smallest 22 million, the largest is 67 million in today's dollars, and obviously we can do this at different time periods if you wish. So then you can see what's the probability. And the idea is, how do you continue to optimize this so you have 100% probability of success? Just to give you some context, if I come back to the plan and then obviously I reduce this to even say 400,000, and I save this, I come back to the chance of success and I rerun the scenario. As you can see, 59%. So $100,000 difference in annual income has basically a 35% impact on my probability of success. So this is the reason why the scenarios are so important. Cool. So assuming you've gone through all this, and there's some really cool other scenarios in terms of drawdowns and comparisons and kind of other details, your milestones, growth rates, and assumptions. What we can now do is we want to create our plan. Because let's say, for example, in this scenario, let's say this is my baseline. I'm not happy with this. It doesn't put me in the position that I want to be in. And I want to create an expected plan. So what I do is I create a new plan. I clone an existing plan, and I pick the plan that I want to copy. So we're going to use this current plan demo, and we're going to start that from now and from today so we can kind of start from scratch. And what this will basically do is copy all of the details across. So this is going to be plan V2, okay? And we're going to start working through creating the plan. So we say, okay, well, do I want to make any changes to this? No. Milestones are still the same. Okay, next. Do I want to make any changes to my assumptions? At this stage, no, because I don't have control over these. I could make these numbers look like whatever I want, but if it's artificially inflating my ego, it's not doing me any favors. Okay, let's look at salary. Well, what happens if I do something else? So let's say, for example, I say business profit. I want that to remain the same, but then I'm going to go custom income, and I'm going to go business profit stage 2, and I want that to be an extra 200,000. And I'm going to have that being yearly, and I want that to start in, let's say, 2026, and I want that to increase and match inflation over time. So I can then kind of treat that as dividend income, and click add. Cool. And then I can see what impact that has. And I say, okay, my cash flow priorities. My cash flow priorities are here. That all makes sense. I'm going to go continue my expenses. That's all fine. If I want to make some adjustments, and then home and everything else, I leave that as it is. And then I skip that, and I click Australia, and then I click confirm. Okay. So this now gives me the new scenario. So what I now have the ability to do is I can compare, and I can do the current state, or I can do it to another plan. For the purpose of this, I'm just going to compare it to the other plan. And what this basically will then show me is what's the change. Okay, so in this particular scenario, I generate $16 million more net wealth as a result of just pulling that income lever. In terms of the change in net wealth, it just gives us a bit of a breakdown of the different components of the liquid net wealth, withdrawals, taxable income, and we can start comparing all of these changes, right? What we can then do is, let's say, okay, I'm really happy with this position, okay? I've made some adjustments, but I'm not really maximizing all of the opportunities that exist. So the big next thing to do is going to be real estate. So, okay, how else do I allocate money into wealth? Okay, so let's say I buy another investment property. Let's call it investment property 1. Let's say, okay, it's going to be 750,000. And we're going to purchase that next year. Okay? It's financed. and we're going to say the down payment is 0, annual percentage rate, let's say it's 6.8% at current interest rates, and we're going to work out the current monthly repayment. It's not great at calculating these things, so what we just need to work out is the P&I repayment. I suspect it's going to be about 4,500. I use the years to pay off to kind of give me a little bit of an indicator. Probably about 4,900. It should be about 30 years. There we go. Beautiful. Now, it's going to appreciate, and we can adjust the amount per year. Once again, I usually like to work off 4%. And obviously, it's giving us a net above inflation of about 0.97%. If you've got specific growth rates, you could potentially put that in higher. So we could put that in at 6%. It generates rental income, and we can put some insights around that. And then in terms of taxes, you can put in some assumptions around improvement costs, insurances, other things. Now, rental income, usually that's going to be about 5%, depending on where you're doing it. Rental management cost is going to be about 7%. And then we can estimate property deductions. Sell, we can say we sell that at retirement. And we're going to say the agent's fee is going to be 2%. Okay. And now we can add this. And then we can continue to add that in. So we can say, okay, cool. What impact has that had over the other scenario? And we can continue to factor in these various priorities. Okay. So this is basically a crash course on how you go about this. And the idea here, guys, is that if we come back to the investment operating system, we want to continually ask these questions when we're running through these scenarios. What can I do to grow my income? And is that income sufficient in order to achieve my goals? How do I control my expenses? And reality, to get to a point where we don't need to control or cut our expenses, we want to make sure that we can live the lifestyle that we want. What do I need to have available to have peace of mind and certainty? We've ticked that off. What are my lifestyle goals? And what financial options do I want in the future? So the next thing is really in terms of the expenses. So, okay, what else do we want to do? Well, okay, vacation. I want to go on extra holidays. I want to spend an extra $20,000 per year. I want that to start from next year, and I want that to go for life, okay? And that's going to match inflation, and that's going to be yearly. Cool, let's add that in. What impact does that have? Okay, well, I get to fat fire by 57, and I get to financial independence at 48. Beautiful. All right, what else? Okay, I want to buy I want education funding, and this is going to be $50,000 per child as a one-off, and that's going to be in at age 41. Add. Cool. What impact does that have? Hold on. I don't know why I killed the plan. Give me 1 second. Cool. So, other things we want to do. Are there other custom expenses, what it might be? Okay, I want to get a Porsche. And that's going to be, let's say, a lease of $1,500 per month, monthly. And let's say we get that at age 45, and yearly change, let's match inflation. Cool, add. So we can continue to add in these various scenarios and see what impact it has. And what we're basically looking for is, what is the income target that we need to achieve in order to maximize on all of these goals? Is there anything else we can be doing to make sure that we're taking advantage of the opportunity? In other words, are we accumulating excess cash that isn't being allocated? And then ultimately what we want to do is we want to get clear on what are the various things that we should be allocating to year on year. So when we look at the plan, we want to be able to see stack by account. And this basically sets us the targets each and every single year of what we need to hit in order to achieve the plan. Okay, so my investments, I need to make sure that goes to 135,000 by next year. Okay, superannuation, got to get that to 123. Savings, got to get that to 114. And this basically then gives us the summary of all of the things that we need to do, and essentially ensure that we're taking the appropriate actions in order to get to those goals. So it's pretty powerful stuff, guys. This is a quick crash course. This video's gone for 30 minutes. The important thing here is for you to actually take the time to go through this kind of process. Sit down with your significant other, ask the questions, go through the investment operating system, run the different scenarios, work out what levers you can pull and the sensitivity of those levers based on your situation, and then reverse engineer all of these goals and aspirations into your business. So then you can work at exactly what activity you need to do in order to achieve the outcomes that are important to you. And make sure that you seek advice, right? We help our clients do this kind of stuff all day, every day. And we've helped our clients amass over $3 billion in combined wealth in that process. And it's a very straightforward process. This isn't rocket science, but it's about having a methodology to start implementing these wealth systems, to improve the quality of your decision making, to make sure that we can automate things, so we can buy back bandwidth, so you're not constantly feeling like you're at the mercy of your emotions and what's happening in the market. And ultimately, we want to make sure we're optimizing and improving once we develop the baseline, what can we be doing to push that pace faster and get to your goals sooner. So if you've got any questions, feel free to hit us up. Let me know in the comments if this is helpful, and look forward to catching you guys soon.